Well, everyone, good morning. It has been one of those weeks where things have been very interesting, to say the least, and they're only going to get more interesting as the day and the week go on still. Now, it feels like today, on this beautiful Thursday morning, has already been a very, very long day. But we've got the entire day to go. We got exactly what you need to do looking forward, what you need to be mindful of looking forward, and so much more. But before we get into all of that, we're going to play that song once again. Different intro song, but the song that really encapsulates what kind of market we're seeing right now. And then we're going to get right into every little bit of it. Hang tight. Good morning, everyone, and welcome to the most entertaining, intellectually stimulating financial podcast in the entire world. You're watching the Atomcash angle, the show that flips the switch and floods the system with straight financial voltage. I'm Atomcash, and I'm bringing you the firepower your financial life may have been missing. Now, whether you're new to trading or a trading savant, I aim to turn complexity into... Yeah, no, that's right. Into clarity with a shot of adrenaline. Ooh, messed up the intro. Here we go. Good morning, everyone. We are already seeing such an interesting open already. The SPY moving down. We had a ton of economic data come through this morning. We still have a lot to go through for the rest of the day, so we're jam-packed today. We got a lot to talk about, a lot to prep you for, a lot looking out into the end of the week and to the beginning of next week. Oh man, it's going to be a good one today. And on top of that, we got some news on the PDT rule. So we're going to talk about that later on in the show. I know a lot of you are obviously retail traders. This could affect you, especially if you have an account that is smaller than $25,000 or any time you wanted to start a small account challenge, whatever. The PDT rule is going to be going away. So I have concocted a little segment for you guys about 5 things on how it could affect you personally. And more importantly, 5 reasons on how it could affect the market as a whole. So some of you, obviously, this rule may not apply to. Some of you may. But we're going to look at it for those that it would apply to, obviously, you, if you have less than a $25,000 account. But everyone, right? The entire market, what the effect is on the entire market as a whole, because that at the end of the day is what we really care about. So we're going to talk about that add a little bit, in a little bit, probably around like 10 o'clock. I am tripping all over my words today. There's a lot going on. I got a lot to get to. Hatchet, good morning. He says, Wet Banana does go so hard. Man, I'm telling you, the band is good. It's a solid band. It's a ripper. That song's also a ripper. And Toby, in the morning, dropping the yer. Beat Eddie to the punch on the yer. Now, this morning, we've got jobless claims, we've got GDP, quarter over quarter. These have already come in at 8:30, so obviously if you look here on the chart, right around 8:30, which is right here. A little volatility right between those two LOIs, as you saw. A little bit overall move down on top of the move down that we've already been seeing. We've had Fed speakers all morning, just so you get an idea of what has already happened. Two Fed speakers, jobless claims, GDP, durable goods, core PCE finals, that's more of like the tomorrow thing. Trade balances, and then we have another two Fed speakers currently right now. We have Williams and Schmid, and then existing home sales at 10, and on top of that, we've got Fed Bowman at 10 also, and then Trump at 11, and then Trump again at 11:15, and then another Fed speaker at 1 o'clock, and then another Fed speaker at 1:40, and then Trump again! Ah! It's going to be a long day, guys. And then you have another Fed speaker after Trump speaks again. And then you have Trump after the bell. And then you have Costco earnings at the end of the day. This week has felt like a month. I don't know about you. And I'll be honest with you guys. This week, my trading, I've cut back. I knew at the beginning of the week it was going to be a hard one for me. And I'm just looking at my log right now. I only made 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 trades, which is pretty light for me. And of those 11 trades, this is my worst week on record for the year so far. 1, 2, I have 3 red, and I have 2 that are sitting red that have just not been realized yet. So realistically, I'm batting like a 60% win rate, which is awful for me. But all these trades I at least have sized down. I took a lot of risk off the table because I knew we were in this little, as I've been calling it, a wet banana market. But yeah, so if you're feeling like you're having a rough week or a rough go of it right now, it's not easy to trade right now. It's a hard go for me personally, as someone who's been doing it for 14 years. And I'm sure you're seeing other people having a little bit of a rough go of it as well. And that's just what it is. Now, the other thing I want to talk about today is how to hedge correctly. I put a little morning thoughts out message for our members in our Discord community over exclusive trading. If you want to check that out, the link is in the description. But I put a message out in regards to how to actually hedge. So I'm seeing people talking about hedging and buying bear positions on the market and whatever, and that's all good and dandy and all, but there's a correct way to do it, especially when overall you are still bullish and the market, as long as it stays above like this general area here, so it's questionable at open, is still bullish in structure. Now, if we get a little bit lower here, it does move short-term bearish, but it's questionable at open. But if we push up on the open, then we are still remaining bullish in structure. Knowing that, there's a correct way to hedge for downside. So we're going to talk about that today also. So especially if you're a retail trader, 2 very important segments today for you guys. We're going to talk about the PDT rule change, how it affects you and how it affects the market. And we're also going to talk about how to actually hedge correctly. So if you have any interest in that and doing it the right way, not just buying straight puts or leveraging certain ways or whatever, I'm actually going to break it down to you and actually show you how you can correctly hedge a bull portfolio where, for example, most of you, or in this scenario, most of your positions may be long equity. How can you protect the downside from the equity and still end up on the upside of the whole, have your portfolio still on the upside of everything is what I'm trying to say here. So, and I'm actually going to use our Seed Accrete account, which is a small account that challenge that I run, how I run it correctly, I should say, in our community as an example, and how I've personally hedged that portfolio for the potential move to the downside here in the near term without giving up any gains. So if that sounds interesting to you, make sure you stick around. We got a good turnout so far this morning. If you guys could help me out and make it a little bit better, Do me a quick favor, if you haven't already. I ask you twice a stream, going to ask you once now, ask you once later. Interact with the stream in any way you can. I know some of you have already said hi in the chat, so good morning to you. Neegum, good morning. Thanks for the what's up. And Toby with the what the hell with all the news, I know. But interact with the stream any way you can, whether you're on X, YouTube, Instagram, Kick, Twitch, or any other site that I'm somehow streaming on. Interact with the stream. Help me with the algorithm. Like it, share it, subscribe, follow me if you haven't. And do one little favor for me. If you haven't already, this is the most important thing. Pop on over to the YouTube channel. Hit subscribe if you haven't already. Once we hit 500 subscribers, this will be an everyday show. So if you like the show and you want to see more of it and you want to hear more of it every single day, then pop over to the YouTube channel and hit subscribe or tell a friend to subscribe. I appreciate your support for the program. Now, we're going to pop over to the VIX real quick because I did want to talk about this. Now, yesterday, we saw a very interesting move with the VIX as it pertains to the market. And we're going to talk about this intraday as well, where we actually noticed the VIX started down a little bit and grinded all the way up to my LOI right up here at around 718, left a few wicks, came back down, and actually closed lower than it opened. However, the markets, so we're saying SPY-Q and IWM, SPY-Qs and IWM, all also finished lower than they opened, which is peculiar. Because, as you all understand, the VIX isn't necessarily a one-to-one relationship with the SPY, or for that matter, the other markets, but there is some level of a correlation here. So just for optics purposes, you can see the SPY opened up here around the 664 area and closed all the way down here, about 3 pugs lower, around the 661 area, while the VIX opened at 657 and actually closed at whoops, that's the wrong candle. Here we go. Closed at 618. So the VIX closed lower while the market also closed lower. And typically when this happens, I like to say, especially if you're in our community, somebody's lying. Positioning is very peculiar when we see this. And now that we're seeing the VIX up in the pre-market with the market down, this could be a little forefront of the lying piece here. As we've alluded to in previous shows this week about the potential for there being an expansion on volatility. So we're going to keep a real tight eye on that, especially with how we're opening here on SPY. So again, the market will retain its bullish structure. I want to be very clear about this. The market will retain its bullish structure if we can get above basically 659.11. If we stay under that, the market will shift bearish short term. This daily candle here, not fantastic, obviously. And these last two daily candles, not fantastic, but we've seen this before where the market has like 2 days of decent drawdown and just whiplashes back up. We closed essentially on the 8 EMA. We wicked beneath it and closed basically on it. We're going to open up, let's see, the 8 EMA currently is at 660.52. So we are going to be $3 beneath it. So we are going to be beneath it. We are going to be closer to the 13 EMA. So that's what I'm saying. It's not necessarily bearish right now, but these are the early signs of some sort of bear move here on the market without some sort of catalyst or something to push it up. And in terms of catalyst, we got a hell of a lot going on today. Like I said, we got Fed speakers, we got data, we got Trump, even at the 7-year. I didn't even mention that. So we are chock full of catalysts today. To be honest with you guys, I may not even make a single trade today. So if you're here to watch me make a trade, if there's a good one, I'll try to take a stab at it. But like I said, in full transparency, I'm having my worst week on record for the year, just to put that in perspective. And I'm just being blunt and transparent with you guys. I actually am having my first red week in a few months, honestly. I've been doing really good. Not to toot my own horn, but I've been doing pretty solid. But I'm having my first actual red week here, and thankfully we saw these signs at the beginning of the week when we talked about the live stream. I cut my size down, but I'm having a bad week personally. So when I have a bad week personally, I try to pull it back even more, especially if I'm noticing trades that I typically take that I would still take 9 out of 10 times that are great risk to reward trades just aren't hitting. That tells me that I need to just retreat a little bit and be a little bit more tactical, a little bit more careful if I even do take a trade. And then when I do take a trade, go on even lighter size, not try to make up the difference, right? We're not looking to make up the loss I've already had. And speaking about me personally, I'm not looking to make up the loss I have already. I'm just looking to be correct again, right? So you don't want to be chasing the dragon of I have a loss, I need to make up my loss with another gain, with another gain, with another gain, and then you over leverage, you go on tilt, you lose it all, right? So a lot of trading in general is psychological. So I figured I'd have this little bit of a powwow before the market opens. So if you are in a similar boat, if you're having a rough go of it the last few days or something, like I personally am, at least you can pull yourself in, rein yourself in a little bit and say, there'll be better days to trade. And like I said before, we are going to talk about how you can hedge your portfolio as well later in the show, so make sure you stick around for that. Strange Maker in the chat with the let's go. Good morning, sir. And Eddie with the yer. Eddie, Toby beat you to the punch with the yer this morning, so I'm a little disappointed, I have to say. A little disappointed. All right, market's opening. Like we said, we're opening, gapping down here on the open so far, and I'm getting a bunch of triggers firing off. Oh boy, I know you can't see them because they're hidden on my screen, but I just had like 7 alerts go off for buy opportunities, so it may be a day to go shopping for equity. Yeah, this is one that I've been keeping an eye on, and this is one I've personally traded in the past and made a lot of money on. AAOI. This one's receiving a lot of hype recently, and this is one I made money on way back here, back in 2016. And I got in somewhere in this like $15 range, and I got out at like $70. And I remember being pissed because it went all the way to like 103. So this is one I am familiar with from a long time ago. So long ago that I don't even have lines on this chart because it was when I wasn't using Webull. And I don't think Webull was even a thing in 2016. So notice the increased volume here on the months on AAOI. Ever since basically the start of 2023, a lot more volume on this name, a lot more interest on this name. Currently, I set a trigger here right around this, just shy of the 50 MA here. You have a MACD crossing over to the downside, a little bit weak on the RSI. So I'm not going to want to rush into this name at this evaluation. But this is definitely one I want to keep on watch today for me personally. And I also want to share with you guys Target. So we're going to talk about Target in a little bit as well. As a name I recently got into long and why. Back to the market, since the market just opened, let's take a peek on things, and we're currently still moving to the downside so far. Volatility, VIX currently above my 1718 trigger, so this is going to be what you're going to want to watch. If we're north of 1718, you're probably going to want to be hands-off today. To be honest with you guys, it's probably just not going to be worth it. You're probably going to want to be hands-off for the most of the day, as a day trader specifically, if we're north of 1718 on the VIX. There could be buying opportunities for equity, which I took advantage of yesterday, and I will continue to take advantage of today. But as a day trader, let the VIX do its thing. If we come back under 1718, there could be an opportunity. That conversion, that trigger conversion here on UVXY is going to be 11, even. Nice and simple to know. If you're above 11, volatility may look to expand. If you're beneath 11, volatility could look to actually compress or decay, which would be nice. Microsoft, a name that I've been bullish on all week, and I've just been getting railed on, unfortunately, is still in such a tight freaking cluster here that it has not had the ability to move out of just yet. But hopefully, maybe today's the day if we can see the market turn around with any of these news catalysts that we get. NVIDIA as well, currently below its POC. This is going to be a massive trigger. If this breaks, it will move up very sharply, in my opinion. So if it gets over 177.50, which is the next strike level, or the next, 2 strikes above, it should move very, very swiftly, which is obviously going to power the SPY to push even higher. Meta sitting on its 50 MA and POC. This could be a good dip buy opportunity if you want to be long Meta. You are in the gap technically because this gap never filled from this ER move here. But we've been in the gap before, so it's not necessarily a bad thing. Every time it's retested that 50 MA here, it's kind of moved back up. So if bulls are going to step in on Meta, you could establish a long position here on Meta with theoretically like a 745 stop, which gives you a little bit of breathing room here to maybe continue the upside on some longer term time frames here. The weekly does look a little sketchy though, to be honest. And the monthly is getting a little heavy. You got 2 topping wicks here, 2 topping tails, whatever you want to call them. So far forming on the monthly, and remember the month ends next Tuesday, so this could also be a hint at a start of some level of a correction here on Meta as well. Google has been moving up pretty solidly. You're starting to get that rounding out. Now remember, if you've been watching the program now for the last month, 2 months, 3 months, whatever, I told you guys, Google is your canary in the coal mine. When Google starts to turn over, all your Mag 7 names will more than likely start to turn over as well. And unfortunately, we're starting to see that the last 4 days, and you can see the trend on all of our Mag 7 names as well, and the watch list on the side there, that all of them are turning over as well. Now, keep in mind where Google is right now, we're exactly at, we've just filled the gap. Hold on, let me double check. Where's low? Low, 41. All right, we haven't filled the gap yet, but the gap fills at 242.08, which is literally right now, 242.10. So that gap would fill right here, basically right now. Oh, we did fill it earlier. So we did fill that gap on the daily chart. So if the bulls were to step in and defend basically this green star as well, so not to break that for more bear momentum, you could see it fill the gap to the upside on the daily here. So keep an eye on Google as a trigger, or at least a means of watching sentiment, I should say, today. As I've been telling you guys, Google is going to be the canary in the coal mine for your Mag 7. This is going to hint to you how the market is leaning either which way with your Mag 7 names in general. EB dropping the good morning in the chat. Good morning, sir. Toby saying there is no your competition, only your friendship. That's so freaking cringe. Open is consolidating around this 814 level. Keep an eye on that for you, those of you that are watching Open. Tesla kind of farting around up here. He did have a nice move in the pre-market in the after hours, if I remember correctly, up to like 450-ish, 445. And that just got like whoosh, he's denied. Picture a guy slamming a basketball and bam, right in your face. And that's kind of what happened to Tesla. Now currently right around this 0.786 retracement. We'll see if Tesla can get some wings here and move back to the upside. Amazon, like I said, under 221 is not looking good for Amazon here near term. Under 221, you're more than likely going to get into this range here where the 200 MA is between 215 and that 210 area. That's where I'd look for the bulls to step back in. I will also say, though, you have 1, 2, 3, 4, 5, 6. This will be the 7th red day in a row. Not that things can't get worse, things can't get more red, but typically when you see a bunch of green days, a bunch of red days in a row, there tends to be some level of a mean reversion. So I would just be careful about necessarily shorting this name. In fact, I would feel even better if it did actually drop much lower, like I said, for anywhere from $4 to $9 and taking a long. So if it dropped dramatically today, I'd actually want to take a long because there's a high probability of that mean reversion to the upside. Obviously coming off an area of support after it's been red for multiple days in a row. So that's what I would be keeping my eye on. If you're interested in trading Amazon specifically. Going back to the market right now, see how things are going, and they are not going good. So far, the market has continued its sell-off from the open, currently down about another $1 or so from the open thus far. Checking out the Qs, and the Qs are also pushing to the downside, along with IWM, which is actually leading the pack of bearishness right now, as we see some retracement here with our small cap names. Currently right around that 21 EMA, which is going to be a key trend point that you're going to want to keep an eye on if you are bullish on small cap names. 237.90 is the number to watch on the daily. We did break the daily green SAR as well on IWM, so you would need to see some bulls step in today and step in aggressively because we are getting pretty close to IWM shifting potentially bearish on the short term. Your technicals down here could support that thesis as well. Volume's been a little bit higher on this rejection on this wick to the upside. Your MACD's crossing over. However, you're still sustaining bull momentum with a 54 RSI and not really like blown out to like 80 or something ridiculous. So it's pretty solid. As I will continue to say, the weekly on this has been nutty. So some level of a cool off on the weekly would make a lot of sense. At least this could be the cool off basically today. So like I said, it's going to be a volatile one today. If you are a day trader, again, if you're coming in, because I'm seeing a lot more people coming in as the day goes on. So I don't know if some of you guys may need extra guidance today, and that's why we're getting a little bit more popular today. But your rule of thumb today, if you are a day trader, is if you do decide to day trade today, you're going to want to size down unless the VIX is sub 1718. North of 1718 and north of 11 on UVXY is going to be a more volatile environment. And yes, of course, you could be more right, whatever. But as we explain on, as I've said multiple times on this program, how the VIX gets its value is the difference in SPX spreads. That is what the VIX is. That's how it gets its value, right? So if the VIX continues to expand, there is a bigger and bigger and bigger price disagreement on where the general market is, which means you theoretically are less likely to be correct with your day trades. And I am a shining example of that as I'm having my worst week of the entire year. And I'll continue to say that because I'm very transparent and blunt with you guys. So if I'm having a hard time, you might have a hard time too. Maybe you'll do great. Maybe you thrive in this environment. God bless if you do. I'm just trying to highlight the potential risks of trading today if you are a day trader. I will also highlight, because I see that our view count is about double since we started, the myriad of potential catalysts coming down the pike today. So we have two Fed speakers currently right now still speaking. Existing home sales at 10. Man, my voice cracked. Existing home sales at 10. Bowman, another Fed speaker at 10. Trump at 11. Trump at 11:15. Barr, a Fed speaker at 1. The 7-year at 1. Logan speaking at 1:40, another Fed speaker. Trump, again, at 2:30. Another Fed speaker at 2:30. And then after hours, you got Costco and Trump speaking again. And on top of all of this, you have PCE tomorrow. And Michigan sentiment. I forgot about that. That's my favorite. Everyone sleeps on Michigan sentiment. We are chock full of potential wild and crazy environment where this thing can get out of whack very quickly. Now, I will remind you, for those of you that came in a little bit later, the market is actually bullish in structure if we recover basically this 659.11 today. If we do not recover that, the market does shift short-term bearish in structure and getting some level of a correction or a pullback. And if you want to know more about that, we're actually going to talk about how you can correctly hedge your personal portfolio the right way in about 5 minutes or so. And on top of that, we're also going to talk about the PDT rule. I've got a whole little segment lined up for you guys about how it can affect you personally and how it affects the overall market. So make sure you stay tuned to that. That'll be a little bit after that other segment. So somewhere in the neighborhood of like 9:50, 10 o'clock. So stick around. We're going to get into that in just a little bit here. Just want to see if the market's going to do anything except go down before we get too deep in the weeds with a segment. Hack is saying, why does Apple have strength? Is it their new phones? I'm the wrong guy to ask. Two things. One, I said I personally wouldn't look to be long Apple this week unless it filled this gap first, which we're not there yet. It's actually showing decent strength, all things considered. So we had a nice push up, and it's not even got like about a 50% retracement of this one daily candle here. So it's actually not bad. Where it actually could just turn around today or tomorrow and continue pushing to the upside. But personally, it's out of my risk tolerance for like a day trade unless we fill this gap. That's just me personally. Secondly, I hate Apple. And I don't hate Apple as like a company or anything, but I hate Apple because they don't innovate anymore and they're just sitting on a pile of cash. And a lot of the times, companies get to the mature phase, they get comfortable, then someone else comes along, does something daring, they take all their market share, they freak out, and they go out of business. I'm not saying that will necessarily happen to Apple because they got their tentacles in a lot of things, but I have a hard time investing, me personally, in a company, and trading it's one thing, but investing in a company that I don't see future prospects and growth coming from Apple, me personally. That can change tomorrow. They could announce something. But as it stands right now, and maybe one of you guys can educate me in the chat, the new phones, the new everything, the only thing that's really cool is the new AirPods that can actually live translate. That's actually pretty awesome. But outside of that, I personally have not seen much innovation. Again, I could be wrong. I'd love to be educated on how they're innovating something. But from what I've seen, I don't really see much. Now, what Hatch is saying is, why does Apple have strength? Part of what I just said is why they could have strength. They're seen as steady, right? It's a company that's in its mature phase. They make plenty of money pretty steadily, and they're sitting on a mountain of cash. So if you did want exposure to one of these bigger names that has a lot of money, that has growth potential, theoretically, Apple could be that. Not that it's growing, but it's stable is what I'm trying to say. So in market uncertainty, this is the same reason why I'm bullish on home prices in general. Even though they're high, I'm bullish on home prices actually continuing to go up because in more volatile, more risky environments, especially as inflation continues to do whatever it's doing, as the dollar loses its value for now, or actually has been gaining a little value recently, these real assets will hold more value. Theoretically, that's why I'm more bullish on real estate, like just homes, literally, because as other things lose their value and depreciate, things that are hard, physical, tangible assets hold their value better in those kinds of environments. So that's what my thesis is on Apple and why it could be stronger than others. It's the same reason why I'm still relatively bullish on Microsoft. And conversely, why I would lean more bearish on NVIDIA, comparatively speaking. Everyone knows NVIDIA is very widely, I don't want to say overvalued, but has a very high evaluation, right? And it's mainly due to the growth prospects of NVIDIA. NVIDIA has fantastic growth prospects. They have basically no competition, and they are leading the forefront of essentially the next big stock market thing, AI, the next big revenue generating thing in the entire world. And Nvidia is right at the forefront of that. However, much of this growth is priced in already and continues to be priced in. So if you still want some growth exposure, and I'm just speaking in terms of generalities, if you still want some growth exposure, but you want to take a better, I guess, from a fundamental standpoint, you want to be a little bit more defensive, you may shift to an Apple or you may shift to a Microsoft, where these are strong companies that have multiple forms of revenue streams that still have exposure to, for example, like Nvidia with AI, right? They still have exposure to the next big thing, but they're more diversified, right? So that's why you could see some money come out of Nvidia theoretically and go into Microsoft now, and Apple, and even Meta actually, and even Google actually. So you may see Nvidia come down a little bit more if we do see more of a bear market. And these other prices, yes, they may come down, but maybe not as drastically. Now, I will say, I don't think, and again, I'm trying to be very cautious in the words I'm picking, because there's a lot of people just freaking out right now, and market's volatile. That's why we're seeing people freak out. Again, if the market closes above 659.11 today, we retain our bullish structure, and we're more than likely going to be bullish into tomorrow. You can snip this, whatever, that I said that, because that's what will happen. But again, we would need to be over this number first, and theoretically, you need to be under 1718. We just wicked my other LOI up here on the VIX at 1775. So volatility is moving pretty aggressively here, but clear resistance there at the 1775 mark. Hatchet says maybe it's relatively strong due to a safe haven perception. Yeah, that's essentially what I was getting at. I'm sorry if I read your comment sooner, I would have roped that into what I was saying. But yeah, that's essentially what it is. Not to mention, remember how I was bearish on Apple when it was like right around here, around like the low 200s, and then they had earnings, and earnings ended up being okay. Wasn't like fantastic. They actually moved down on their earnings, and they had some news come through that popped us to the upside. We broke the 200 MA, so now technically speaking, we're kind of like just stair-stepping. We broke the 200 MA, and its trend is pretty bullish comparative to Microsoft, which is questionable. It's trying. Also, we don't sit here in dead silence. So a lot of things we like to do on this program that a lot of people aren't going to be doing. Hatchet says the time delay makes conversation a little awkward. Yeah, well, can't do much about that. And Strange Maker saying VIX. I don't know if he meant popping or pooping. It popped. Now it's pooping. So I don't know if that was a typo. We had the pop, now we have the poop. So we'll see. Under 1718, we're pooping. Under 1775, we're popping on the VIX. That's all you got to know today. Between this, very volatile. All right, it is 9:50, so I'm going to ask you guys one more time. Like I said, I asked you twice a stream. If you haven't already, do me a favor, interact with the stream. I know a lot of you guys are talking to chat. I appreciate it. But if you haven't already, like the stream wherever you are. Follow me if you haven't. And if you haven't done this specific action already, do this for me. Pop over to the YouTube channel, hit that subscribe button. Once we hit 500 subscribers, this will be an everyday show. So if you like the content here and you want to see a lot more of it, do me a favor, hit that subscribe button, and I will be very happy to have your support. I don't know. Sometimes I just ramble and I don't know where the words are going. The gift of gab is sometimes a curse. Anyway, we're going to roll into our first segment here, but I just want to remind you guys, because as I'm talking, we will probably see more volatility. Actually, existing home sales just came through at 4 million. So that was scheduled for 10 o'clock. That actually just came through. So between now and probably the end of the show, the two catalysts that we have right now are, Fed Schmidt is still talking. But then we also have Bowman scheduled to speak at 10 and Trump scheduled to speak at 11. But he's greeting the Turkish president, so probably not anything major, or unless he just mutters something. But more than likely, should be at least some period of cool down. We'll see how the VIX reacts. So I do want to talk about, here, let me pull up my notes. We're going to talk about the PDT rule. Actually, here, let's vote in the chat. I want to talk about today about how to hedge your portfolio properly and the PDT rule change. So if you want me to talk about the PDT rule change first, drop a PDT in the chat. And if you want to talk about hedging first, just drop the capital H in the chat. So let's take a quick vote. PDT or hedging. I'm going to do both either way, but which one would you guys prefer to listen to first? While you guys are doing that, and while the stream's catching up, because we're obviously on a delay here, we're going to take a peek at the market and just see if anything major has changed, which not really. Again, you guys already know what I'm watching here on SPY. Looking like we're making a little bit of a V recovery in general across all three. And this is actually a good sign if you want to be bullish on the day, or if you have any bullish aspirations on the day, that we see all three markets move in unison, which they are right now. We're all on the same page. There is no divergence right now. This is a great sign. And the VIX moves to the downside. So far, we actually have the perfect storm of everyone moving together. You've got all three markets moving together, and you have the VIX moving down. So this is actually very, very good if you want to be a bull or hope that there's a bull reversal, whatever. This is leaning very bullish in terms of a reversal. You are nowhere near out of the woods yet. Again, you are nowhere out of the woods until we're at least like $2 higher from here on SPY. So we're not out of the woods by any means, and you will see this, a rejection. But the fact that the indexes are moving together is a good sign in general. Even if you're a bear, it's a good sign because there's less confusion. When there's a divergence, it makes things a little muddier. So the fact that the VIX and the three indexes at least the three indexes I watch, are moving in unison, are a good sign at least of some uniformity today. So if there is a bull move or even a bear move, it will be supported by everything moving together, which makes it a little bit cleaner to trade if you do decide to trade. All right, since Toby is the only one who voted, we are going to talk about hedging first. So let me just pull up my notes real quick. Dooba 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 dooba. Okay. I guess I'll leave SPY up for this. We'll leave SPY up for this. You guys can watch SPY while I'm jibber jabbering. All right. I did have some of my stop losses trigger, and that's what we're going to actually talk about here. I was just checking up on them. But I did have some stops get triggered, which I'm actually not mad about because they both triggered in profit, so it's a win. Anyway. This is how you are... How do I start this? Many people talk about how to hedge a portfolio, and very few people do it correctly. We talk about how to hedge things. We buy puts. We just aggressively buy directional calls or directional puts and think that that's actually hedging a portfolio when it's really not. So I want to talk about how you can actually hedge your portfolio successfully, especially if you're a small account. Now, specifically speaking in the realms of hedging, we'll define it really quick on what hedging actually is. And hedging is basically preparing for the inverse of what your portfolio is positioned for. Most people are positioned long equity, right? So for the sake of this conversation, we're going to focus simply on a long equity portfolio. So, and I'm actually going to use an example from our community exclusive trading. It's our Seed to Tree program, which is essentially like a small account program. Currently that account's sitting at around $4,000. So I want to use that as an example so you guys understand kind of how to apply it to your own trading and how to hedge appropriately. So this portfolio is sitting at about $4,000. And I would say roughly 80% of the portfolio is allocated to long equity. And I would say roughly 1% of the portfolio, maybe 2%, is allocated to a bear position. Here's why. If the market is still structured bullishly in general, even if there's a period of pullbacks like we've been seeing the last few days, I want to prepare myself to capture as much gains as possible. But if I'm doing the number one rule of what I share with you guys on this program, on my channel, on our Discord community, not lie to myself, I also need to say, things may be a little overheated, things may be a little hot to the upside, I should probably buy some protection, which is actually how you're supposed to use options in the first place. A lot of people trade options. I trade options myself for a living, but options are actually supposed to hedge your long equity, essentially. That is how you should be using options, and not everyone does that. And myself included, I don't do that either. I buy options to make money, right? I trade them back and forth, whatever. But when you're talking about a portfolio, and again, we're using this $4,000 portfolio as an example, and we'll say, like I said, 80% of the portfolio is roughly long equity. Now, in my scenario, most of this equity is actually profitable. So essentially, I'm putting stops on at above my break even. So I'm only losing opportunity cost, meaning if I'm putting stops, let's just say use simple numbers, at 10% and everything's trading at a 20% gain, even if things come down, I'm stopping out at 10% gain, so I still made 10% over my original entry. That's good. Yes, I did lose 10% gains, but I still made that 10%. on the original start of the position. So long term, that's a good thing. Let's start there. Now, if I want to actually hedge myself for any potential downside in the market, you want to take an offside, lopsided bet on the market. What do I mean by that? Well, me personally, I took last week when the market hit its high, literally at the close of this candle here on 9/22, I actually opened up a put debit spread. A 650, hold on, let me just double check before I talk out, before I misspeak. I opened a 650, 649 put debit spread. And I opened, in this scenario, 5 of them for 19 cents a contract. So that means I'm putting $100 on the line. We'll round it to 20. So I put $100 on the line for this trade. Now, if this trade goes to a full profit, I make $400 in gains because it's a $1 spread. I bought it at 20 cents. The max it's worth could be $1. So the max I can make is $400 on this one trade. It's a lopsided bet, and the most I could lose is $100. So I have a 4-to-1 risk to reward profile on this trade. Now, in the event the market takes a dump, like I just said, all of my long equity will get stopped out. So when we're seeing an overextended move, you want to start using stops on your equity trades. You want to be very careful, put those stops in, lock everything in that you can. You are giving up that opportunity cost, so that you have to calculate on what that is really worth to your portfolio. So yes, you may lose 1% of potential gains on your portfolio. So in this case, let's say if all my stops trigger on the 80% of my equity, and let's say I lose $200 to $300, again, theoretically, of potential gains, right? Because this is just extra gains. Then the put debit spread that I had, which if I cash it out at full value, in this case, all theoretically, I would actually make a $100 gain overall during that time period of volatility. And most importantly, I'm sitting all cash now. So as all my positions get stopped out, now I'm cash. Now I can go out and buy while the market's dumping, or take advantage of new positions that hit key supports and buy and reposition myself, or the names that I really like that had a lot of great momentum that just had some downturn on it that got stopped out. Maybe they got even lower and I still really like these names and I want to get back in. Now I have a better average or a better entry, whatever it may be. And I protected my cash and I actually made a gain still. Now, what you don't want to do, well, actually, before we say what we don't want to do, let's go into the opposite scenario where it doesn't work out, meaning the hedge doesn't work out. So like I said, the 80% of the portfolio that's still long equity, and again, we're theorizing that 20% sitting in cash, just for simplicity's sake. 80% of the portfolio that's long equity, the market continues to rise, right? Now I'm losing, that put debit spread goes worthless, right? So now what was $100 is now worth $0. So I lost all my money there. But again, this is all in theory. If those 80%, that whole 80% of my portfolio continues to the upside, and again, we're using this $4,000 portfolio as an example, so we'll just say, it's not exactly, well, actually here, I'll get the exact number. 4,000 times 8. So we'll just say $3,000. It's $3,200, but we'll say $3,000. If that $3,000 at least appreciates, what, 1%? Not even, 0.03%. So if all of my equity, everything, at least goes up 0.03%, I have fully covered my put debit spread, because that would be a $100 gain. So as long as all the stocks, for more simplicity, if they go 1%, I've now made $300 on my equity. Again, unrealized gains, but $300 on my equity with a $100 loss on my put debit spread. I still net out a $200 positive. So no matter how you slice it, when you take a lopsided bet on the market intentionally to hedge a portfolio, that is the way you do it. You do not want to take directional puts unless you know what you're doing, because a lot of the times bears get wrecked. A lot of the times. Bears get squeezed, bears get wrecked, bears get overconfident. And how typically the market works is the market likes to reward bulls slowly. As I like to say, bulls take an escalator while bears take an elevator, right? As a bear trader, you typically get your gains pretty quick. As a bull trader, it might take some time, right? Sometimes you get explosive moves, short squeeze, etc. But typically, bear moves tend to be sharp and rapid, and bull moves tend to be a little slower. So as a result, you intentionally want to take an offside or a lopsided bet that is a bearish bet on the market to hedge your portfolio, because if you're still betting that the market may kind of go stair step its way up, the money you're making on your equity is actually going to offset the cost of that bear position. Now, if you wanted to take a larger bear position or a more aggressive bear position where, in that case, let's say you buy a put debit spread that is 50 cents versus 20 cents, you could do the same thing and just take fewer contracts. But if you took the same amount of contracts, now I'm betting, again in this scenario, $500, and the risk to reward ratio is very different. Now I have a 1-to-1 risk to reward scenario on the spreads, and for my portfolio to cover the cost of the spreads, I now need almost a 2% gain to offset the loss behind the put debit spread. So as you can see with that real quick simple math, taking in this case, a cheaper spread is actually more beneficial in this scenario because it can yield a wider, larger return. And if you're actually hedging appropriately, that is a more favorable position to take versus a closer to the money bear position, unless you're trading, again, you know what you're doing, whatever. But for most people, most retail traders who are long equity, taking specifically a bear spread, a put debit spread, is the way to go with the right risk to reward ratio. So that's how you should consider hedging your portfolio appropriately. The amount of the spread or the amount of the bear position, whatever you want to do, should be able to offset the opportunity cost of the equity. That is very important. If it can't offset the opportunity cost, then you're doing it wrong, or at least come pretty close, right? Otherwise, don't hedge. If you don't know what you're doing, don't hedge. Just put your stops on and ride it out, man. Because a lot of the times people put way too much money in when they're hedging because they're preparing for downside and they lose hundreds of thousands of dollars because they just buy puts recklessly and they don't know what they're doing. But when you look at the potential opportunity cost, how much am I thinking my equity is going to make, or how much would my equity have to make to offset this bear trade, and how much would the bear trade have to make to offset my opportunity cost that is lost, right? Realized gains that are realized lower, to offset that difference to at least net my portfolio out in the green. That is how you can hedge yourself successfully when the market gets a little more volatile. What do you think, guys? What do you think about how to hedge correctly? Was that helpful? Was that not helpful? Do you have any questions? Let me know in the chat. It's looking like right now on the SPY, as I was talking, I was watching this little green little stick here. And I was guessing it was NVIDIA, and it was. Watch right around here. Watch like 657. We'll break 657. You might see some volume flooding on the SPY. I'm not trading it. I'm just saying what to watch. You could do you. I'm personally not going to trade it. Grab is still sustained over that 591 area, and I got my little bit of a cool off. I actually might sell puts on this. I was debating it this morning because I was looking at it pre-market. I was like, maybe I'll sell some puts. Not really going to get much for the sixes. What about next week? Still not going to get much. We'll see. If there's more bearishness, if we actually get down like under 6, I'll look to sell some puts on Grab at about $6. Even the October ones aren't even worth it. They're like 30 cents. Toby said you spoke very fluently. Great presentation. Thank you, my friend. Glad it was helpful. We're going to watch the SPY here just for a minute before I get into the PDT rule change, because like I said, if we break right here, like 657, we could see some volume flood in and the market may get a pretty sharp reversal. We're forming a nice little W here, nice little double bottom. So if the bulls want to take a chance at it, you got the double bottom on the Qs. It's actually more bullish on IWM, higher low on IWM, so no double bottom. And look, where the VIX is, right at 1718. We're right under it. So this is the time. This 657 could act as a trigger to pop here to the upside. Might get a quick little pop here. Like I said, on the day, we got to get over 659.11. If we get over that, then we're still sitting bullish. You'll probably expect a bullish day tomorrow unless PCE tanks things. Hatchet said, I had not heard the idea about offsetting opportunity costs. Makes sense. Yeah, a lot of people look at their current portfolio and they don't think about, like, okay, if I put a stop loss in, like, okay, I make less money, but what about the more money I could make? So there's actually a really good quote about how day traders will trade a stock and they'll celebrate making, going from $10 to $11, $11 to $12, or sorry, going from $10 to $11, going from $30 to $31, and $50 to $51 on the same stock. Like, yeah, you made $3, but if you stayed long the equity, you would have made, whatever it is, $40, right? Comparatively speaking. So, while it's not the same because you're probably trading options if you're just making the quick dollar moves or whatever, having that mindset, especially like long equity, because the market, like, you always want to be long equity as an investor, always. Like, there's very few times you don't want to be long equity, but the times you're not long equity, you want to look at the opportunity costs. For example, like Grab. I'll use Grab as an example. I moved up here. Let me actually check my log. Where is my grab? Grab. I'll tell you guys a real life example here. So I tightened my stop loss on grab to 590, which is just below my 591 level, which you guys know I've talked about in the program quite a bit. Because I'm weighing the opportunity cost, right? Yes, I could cash out where we tapped my price target of 661, which it tapped almost perfectly to the penny. I'll pat myself on the back here. Don't want to pat myself too hard, I might break something. Did pretty good. But I understand the opportunity cost that if I stop out too early, like if that stop's too tight, I could be missing out on my ultimate price target of getting up here to like 1079, which is almost like 100% gain still, especially from where I'm positioned down in like the fives, right? So if we do trip this level here, I'm risking, essentially, if I put a tight stop up here from 661, I'm risking about 70 cents here, right? Still of unrealized gains. But if we break this level here, then there's a good chance this retraces lower. On top of that, that bear position I was just talking about is going to pad the loss here of the unrealized gain. The 70-cent loss here, again, on equity, will be padded by or offset by, at least in theory, if the market's seeing more of a downturn. Now, grab could obviously just see a downturn itself, but I'm just trying to give you guys like a one-and-done example. A bear position, theoretically, would offset any downturn here. Now, grab is kind of memey. It's got high volume, whatever, so that, again, this may not be a one-to-one comparison, but I want you guys to understand how I risked my total gain here. Yeah, I could have sold here, waited if it came down, but if I sold here and it popped off, I'd be pretty upset because I'm long equity. I don't have a timer. When I trade options, I do have a timer, and that's a very different mindset. You want to be able to shift gears. So in this scenario with a tighter stop loss right down here at like 590, I'm still giving it enough room to breathe. But if it does trip, then theoretically the market is seeing some downside. Theoretically, my bear spread is up, which right now it's up about 50% or so. My bear spread is up to pad the potential opportunity cost loss there. And then theoretically I could get back in after the market's done, after it looks like it's actually seeing some level of reversal. I can get back in and go long again. He said, great take. I stopped taking directional puts and started using spreads. I think that's really the way to go for a lot of people. Unless you are day trading puts, like you're actually like you see me do on the program. If you're looking to swing puts, most people are going to see a lot more success and a lot more, what's the word? Calamity. You're going to feel calmer about trading spreads, bear spreads versus directional bear puts. Yes, directional bear puts can make you more money. And if you do want to trade directional bear puts, the one thing I would say as a piece of not financial advice, but something for you to consider, is buy more time and go closer to the money if you really want to. But again, you should really be knowing what you're doing if you're messing around with bear positions in general, if you're not day trading them. Because the market is designed to go up. I will remind you guys all of this. SPY, the S&P, is made of the 500 best companies in the United States. When one of those companies sucks, guess what? They get kicked the fuck out, right? So the SPY is literally designed to go in a, just continuously go up over time. That is how it's designed as an ETF. And the SPX is designed to consistently go up because when one of those companies sucks, they get booted out and replaced with a better one that's going to grow. So you don't want to be haphazard with puts in general. You don't want to swing puts in general, especially on the market, because you're probably going to get a boo-boo. But if you're taking managed risk, meaning, again, like an offside trade, like when I say offside, I mean your risk to reward greatly favors one way than the other, and you're risking a small amount of money to make a lot of money, that's worth it. Like with the example I gave you with the portfolio, risking 80, 100 bucks, however much it is, to make 400, right? So that's a 4-to-1, and that's a big gain, especially for the size of the portfolio. That's a 10% gain on a $4,000 portfolio. That's massive. And assuming all those stops get taken out, maybe it ends up being a 5% gain. But you know what I didn't do while the market took a dump? I didn't lose money. I made money. And now I'm all cash and I can buy more things. It's that simple. Hatcher says, buying the dip today makes sense as econ data was strong so far. Yeah, it was basically a good news is bad news kind of day. But everyone's playing the game of what's going to happen next. What is the Fed going to do next? And it's basically a guessing game here. So even though economic data may have been good or seen, I like to say when data is perceived as bullish or perceived as bearish, economic data was perceived positively. However, it was received bearishly. That's why I say good, like, I don't like to say things are bullish or things are bearish as it pertains to data. I like to say things are perceived good or perceived bad. In this case, it was perceived bad, even though the data was good, right? We're tapping the 200 MA, and we're technically over the open right now on SPY. Again, I will continue to remind you, this number is all that matters. 659.11 above that, we actually keep a bull structure and more than likely continue to push into tomorrow. Also, it wouldn't shock me to see some bear squeezing going on. Man, this daily candle is going to look gnarly if we get a push today. Some bear squeezing after basically a 10-point drop from the highs. I've seen a lot of rhetoric about people being aggressively bearish and stuff, so wouldn't shock me to get a nice squeeze today. Just saying, would not shock me. Toby says, would love for you to do a segment for the wheel strategy or generally selling options as investments in some scenarios. Toby, I'll do a little quick one for you right now. Grab is a fantastic example where I want to be long grab. And that's why I just kind of alluded to I would sell puts. And I sold puts on, here, actually, I'll give you two examples. I sold puts on open this week, live on the program, actually. And I sold 7.5 puts down here. I think it was trading around 7.5 because it dumped right after. I remember doing it live. It was around like 7.4. And let me double check what I sold them for. I think I sold them for 50 cents, 53 cents. I sold them for a 57-cent credit. Now, I actually closed those out for a 70% gain. It was somewhere like 18 cents or whatever. So that was just cash in my pocket. But for me, had that gone against me, right, I would have to be okay. And when I'm wheeling things, you have to be okay with owning the stock. If you're not okay with owning the stock, do not wheel it. Do not sell puts. Do not sell covered puts if you're not okay with owning the stock. In this scenario, my break even on this trade would have been $6.93 because I sold them for 57 cents. It was a 7.5 put. You subtract the credit out of the strike price, and that's your break even. So had it closed under 7.5 by the end of the week, I would have been assigned shares. Theoretically, depends on how your broker does it. I'd either be assigned shares at 7.5 and kept the cash, or assigned shares at 6.93. So either way, I was okay with owning shares just shy of $7 at 6.93 with a risk of like roughly the 616 area. So for me, that gives me at least 10% downside there if I own the shares at a lower cost basis. Or in this case, I can just keep money, which in this case, I just kept the money. Ended up netting, hold on, let me double check. Like I said, it was about a 70% gain. I closed them out at 17 cents, right? So I netted $40 a contract. And that was worth it to me, right? I'd rather net the $40 than hold on. And that goes for selling any options. Once you get under a certain point, you're better off just getting out unless you really want to ride it worthless, but you're better off just getting out and realizing the gain. Now, for something like Grab, which I wish there was a little bit more volatility, I want to own more shares. I don't mind. I want to own more shares. So as there is a period of weakness here, if it comes down to this 591 level, I'm telling you guys right now, I'm selling $6 calls. I'm selling 5.5. I'm selling puts. I'm selling $6 puts here. I may even sell 6.5s. It depends on what the difference is. Knowing that those 6.5s would be assigned to me, more than likely, but I could capture depending on the cost. Let's just see. So for example, if I sold the 6.5 puts right now, my break even would be 605. So I could sell them right now. Now I run the risk of assignment while I'm holding short the puts. But my break even is 605. So if nothing happens between today and tomorrow and I'm not assigned, because I could be assigned at any point in time, theoretically, and we close out at 615, then these decay to 30 cents a pop. Because that's what they would be worth at close, right? Difference of the strike versus the current price. So I could just make money on these too. And if it goes bullishly, goes in my direction, then these would decay much quicker as well. So it kind of just depends on your strategy. If you're looking to make money, and like in my case, I don't mind getting assigned the shares of Grab, especially if I sell the 6.5s. And let's say, again, they fill for 45 cents. That means I'd own shares at $6.05, which would actually be under today's price. So it wouldn't be the worst thing in the world. So it kind of depends. You want to shop around to different chains to get an idea, and it depends on your personal theory. What about Toby says, what about longer dated puts to sell? Is it dependent on the situation? A lot of things are very situational. What I like doing, me personally, I like selling shorter dated puts because they decay faster. So it depends. Am I looking to generate income? Am I looking to take advantage of a sharp move in the stock? Am I looking to take advantage of a potential longer move on higher IV? For example, maybe on this move, and totally in theory again, maybe on the sharp move on grab here when it was like just hit $6 for the first time or recently, right? Maybe the puts at that time for a month out were $1 and now they're 70 cents because the IV came down, right? So in that case, it really depends. It's very situational. There's nothing wrong with selling a longer dated put. You just assume more risk as time goes on, theoretically. Because, well, yes and no. It's a two-pronged sword. It's a double-edged sword because you do assume more risk in one hand because as time goes on, there's just a higher likelihood, unless it just rockets, right, that you could be assigned, and there's a higher likelihood that the premiums get more erratic, obviously, because as you get closer to expiration, you guys see this with weekly contracts, prices do this real quick, right? Contracts go from 0 to 2,000% sometimes on crazy moves. Things can just happen. So depending on the individual stock, if I want to own the name, how bullish I am short-term, long-term, and how much I get paid, most importantly. There's a few things to weigh, so there's not ever going to be a one-size-fits-all. It really depends. Toby says, let's say you get assigned, so you get the shares and then sell a longer dated put. Well, if you get the shares, then you'd want to sell, theoretically, a call against it if you're trying to wheel. Because if you got assigned the shares on a put, then you'd want to sell a call against it to generate more income. But that way you could be capping your gain on the stock as well. So you want to be mindful of that. You could sell another put to keep building your position. There's nothing wrong with that. But getting the shares assigned to you and selling another put wouldn't do anything unless you're looking to, again, build a bigger position. You may be wanting to theorize selling calls against the assigned shares, which is that's how you wheel correctly. You sell cost secured puts, cash secured puts, there we go. And when you get assigned eventually, because you will eventually, if you keep wheeling and wheeling, the shares that you own, you want to sell calls above that strike price, because that way you always make money no matter what. Now again, you limit the upside when you sell calls, right? So you have to be mindful of that, whereas owning the equity directly could yield you a better return. It really is very situational and very dependent on the stock. All right, let's take a peek at the market. We are farting around that 200 MA here. Ooh, VIX taking a little bit of a nosedive, trying to round out down here, but we did break that 1718. And all three indexes that I watch, at least, are moving in unison. So this is a good sign. IWM still below the 200 MA. Q's backtesting and SPY backtesting. So if VIX continues to drive lower, this is going to be rocket fuel for the market, and the market's going to have a hard pop. Hard pop. Again, you got to get over 659.11. That puts us still bullish on the daily, specifically. We retain bull structure, and we can still theoretically push to the upside. That does not happen without UVXY being under 11, which it is. The VIX being under 1718, which it is. And ideally, all three indexes moving in unison, which we're seeing. So far, we have the perfect storm. All the indexes are moving together, and the VIX is decaying, which is the perfect storm for a sharp reversal. That is a perfect storm for like a V-bottom kind of move. But you're still not out of the woods, so I don't want to hype anything up, and I still want to go back to the beginning of the stream where I said today is a very risk-off kind of day. I have not personally made any trades. I've talked about where opportunity lied and where you could have made money, but I've not made any trades at all today. And I will probably keep it that way, to be honest with you. I already have exposure on names that I'm underwater on, and that's okay. Like I'm underwater on Microsoft and NVIDIA right now, and SPY. I'm underwater on three of the positions right now, and I'm not looking to increase my losses. I'll just be honest with you guys. I'm not going to chase the dragon of I have losses this week, so I need to trade more aggressively to make more gains. It's okay. I can have a red week. It's not the end of the world. And who knows? If things end up breaking like I say they could break, maybe the market makes an aggressive turnaround, and maybe I make a lot of money still. Anything is possible. All right, I do want to talk about the PDT rule. Let me pull up my notes there. Any other questions, guys, before we roll out of the whole hedging and other market plumbing conversation? Real quick, I'll let the stream catch up. If you have any questions, feel free to drop them in the chat. While you guys are doing that, I'm going to pull up my PDT notes. that I made for you guys. Actually, here, what I'll do is, let me do this, because I need a drink of water desperately. So I'm going to put on some royalty-free music for you. Let me see. I'll put on some royalty-free, some AI music for you guys real quick. I will be right back. I'm just going to grab some water. While I'm doing that, if you guys have any questions, feel free to drop them in the chat. It will probably be like 30 seconds. Don't go anywhere. I will be right back. Until then, enjoy the jams that I made on Suno AI. Baby, some electricity in the chat. Woo! A little energy there. Nice little wake-up call. A little bit of a little shred session there. Not too shabby. All right, market's getting pretty close to that trigger level here. I'm gonna wait just a minute or two before we get into our PDT rule segment, just to see if we get a little bit of a ripper through that level. Let me actually check something here on my second screen. And let me actually verify that nothing else changed. Remember, we are in a landmine. We are in a minefield. There's the word I was looking for. We're in a minefield of news catalysts today. Please keep that at the forefront of your mind. Be very careful with any trend in any direction. As I anticipate the market being very volatile for the entire day. Yeah, we'll watch this 559.11. I want to say 660. Let's look at the options chain real quick. Yeah, look at 660 today. Look at your open interest on your 660, even your 559. So your 559 is going to give you some bull push. Again, we're just talking about delta hedging here. You've got a 2-to-1 almost on your 659. So that lines up with my 659.11 level to get a push to the upside if it breaks. And you're dead even here on the 660s. Dead even on the 661s. And you get more bulls than bears. Again, theoretically on the 662s. And on the 663s. And a huge, look at this. 664. If we get above that, we are squeezing hard. We're getting back to the devil's number. If we get above 664 today, we're going to push real freaking hard. All these puts are going to be pushed out the money. You've basically got a 4-to-1 relationship here on the 664 chain on the 0 DTEs, a 3-to-1 on the 665s, and a 8-to-1 on the 666s. So if the market does succeed, we're on my trigger level right now, 659.11. If the market does push, it's a kind of a desert through here. I would say 663 is your first sign. If it gets over 664, oh mama. We're getting back to all-time highs today. Today. I said it. Say it with my chest. Boom. We're getting back to all-time highs today if we get over 663. Assuming volatility and all the other things I said earlier. Yup. I stand on that. All right, let's get into the PDT stuff. I'll keep this on the 5-minute. You guys can watch that if you like to watch that. PDT. Alrighty. Cool. Yesterday, FINRA announced that they approved the removal of the PDT rule. If you don't know what the PDT rule, essentially it limits the amount of day trades you can make if you're in a margin account underneath $25,000. Now, this is going to send shockwaves across the market. It's not approved yet, right? They announced the approval. It's not implemented yet, I guess I should say, but it's coming down the pike fairly soon. Now, what does this mean for the market? What does it mean for you as a potential small account trader? I'm going to list 5 points on how it can affect you personally and 5 points on how it can affect the entire market as a whole and what you should look out for with this rule change. Now, most importantly, let's start with you, the retail trader. This offers you way more flexibility in a margin account. So retail traders are no longer going to be forced to maintain a $25,000 amount, an equity amount, and able to day trade successfully over and over. Now, as it stands right now, if you have less than $25,000, you are limited to your 3 or 4 day trades before you're flagged as a pattern day trader, and then you can't day trade or something. I don't know, but it's not something I'm concerned with necessarily. But for you, as a potential small account trader, that will give you the ability to day trade, not to your heart's content, because you're on margin, right? There's a certain limit, but to day trade more frequently. Now, I like that quite a bit because there are many times where I've seen people who trade as day traders or as aspiring traders, and they get stopped out over and over and over and over and over, right? Or they simply over leverage into a position because they know, oh man, I can only make 1 or 2 or 3 day trades. So they over leverage into a position and they don't take profit soon enough simply due to the fact that they can't, or they want to catch as much profit as possible. And that can actually cause some bad trading habits. So now with this new rule, or at least the removal of the PDT rule, you'll be able to day trade, not to your heart's content, but you'll be able to day trade in and out. You'll be able to use tighter stops, right? So you don't have to risk praying that something turns around. You can just get in and out as you please. If something fails, you can get back in. And that's going to give a lot of retail traders a lot of flexibility, which I actually like quite a bit. In general, that's also going to lower the barriers to entry, especially with how we've been seeing how the barriers to entry have been lowered on a lot of brokerages. People can trade for free now. Newer accounts, smaller accounts can engage in more sophisticated strategies for intraday trading if they so please. Because they used to not be able to do that because of the PDT rule, and now they can. And that's fantastic. So you can learn, especially with a smaller account, sooner than later because you don't really have that privilege of implementing certain strategies as a bigger account or until you're a bigger account because of that PDT rule. So this may give you personally some flexibility because there will be a lower barrier to entry to implement some of these kinds of strategies that may involve day trading or being able to get in and out of a position the same day. Now, with that being said, there is some downside, and the downside is a potential increase of risk exposure. So without this safety buffer, theoretically, inexperienced traders can take outside trades or outsized trades and take way more risk and suffer bigger losses quicker. In my opinion, I don't think that will affect many people. I think if you're going to full port, you're going to full port on a day trade and you're not going to care about the PDT rule. You're just going to full port because you're going to full port, right? You're going to make a dumb move. You're going to make a dumb move. So I personally don't think this 25K safety buffer has done anything for anyone. I think it's a load of horse crap. From the start, I thought it's a load of horse crap that there's a safety buffer that, oh, be careful, you don't have enough money, so you're not trusted to day trade. I think that's a load of crap. But there is rhetoric out there that if you don't have enough money, then theoretically you'd be more adverse to make worse decisions, which I think is stupid. But I guess I should highlight it here, and I am highlighting it here nevertheless, because there could be someone who overtrades. And that is another point where people are overtrading. They may normally have only taken 1 trade or 2 day trades a week, and maybe now they're taking 10 or 20. And as a result, they're increasing their exposure to have a higher chance of being wrong and consequently lose more money. So there is a give and take to that relationship where, yes, you could have tighter stops and you could get in and out. In the same way, you could have death of 1,000 cuts theoretically. So there's a give and take there. It depends on you. But I feel like most I want to say like intermediate experienced traders would actually benefit in general from the PDT removal. In general, this also would allow more expansion on strategies and abilities to I guess compress alpha opportunities as a whole, where there are more short-term trades again that you could now implement with a brand new strategy because you're allowed to get in and out and in and out and in and out, whether that's selling options, buying options, getting in and out equity, long, short equity, whatever it may be. That opens up a world of opportunities that you may not have had in the past. Now, the most important thing, and I have this as my fifth point, is the psychological impact. Again, people may overtrade, and now people may already have that overtrading or may already feel FOMO and they overtrade already as it is. And theoretically, maybe they can't day trade certain days because they've hit their limit of day trades, right? They've hit their 3 or their 4 in the week, whatever. And now they just can't do it. So that actually stops them from making a day trade, where in this case, if that rule is removed, then they can go ahead and day trade anyway. So again, it could dig a deeper hole for some novice traders. But in general, I'm of the mentality that if you're already going to dig that hole, you're already going to dig that hole. And eventually it's a tough lesson that some people just have to learn. Unfortunately, it is what it is. Overall, I believe it's a net positive for retail traders. But let's roll into what's actually really important, and that's the effect on the entire market as a whole. So yes, this PDT rule could give you personally a great advantage, but how would it affect the entire market? So theoretically, because there's the ability for people to move more freely in and out of both calls, options, equities, everything, intraday volume and liquidity, especially in our smaller cap names, micro cap names, very illiquid options as well, people will more actively trade these vehicles, I guess I want to say. And as a result, that volatility and that volume will also increase. So we should see, theoretically, higher volume, which isn't necessarily a bad thing. But all of this is in theory. I'm going to stop saying theoretically. Higher liquidity and higher volatility could come along with that as well. So that could lead to more rapid price swings, both for and against, whatever, however you're positioned. Especially as shorter term capital will look to chase moves. Again, if we're assuming retail traders or FOMO traders or anything like that, as moves move up or move down, they could be a little more extended to the downside or the upside than previously because people were FOMOing in, riding the train, and that could push things more aggressively either which way. In theory, I actually think this is going to be worse for market makers because I think it's actually going to diminish their current edge or their current algorithms, however they're structured right now. Because it's going to provide more noise, right? There's going to be more retail noise, right? So yes, large institutions obviously trade and they make the bulk of the volume on the market. But what happens when retail traders, who may only be, let's just use whole numbers for simplicity, like 10% of the market volume on whatever name, what happens if that 10% is now able to trade over and over and over again, and now they make up 30% of the volume? Well, that just throws out some people's edges completely. It could. That could change the game for a lot of stocks in general, right? So you got to think about that. Again, that's more of an effect on the market makers, less of the effect of you and me. But it is something that's very interesting. What we'll see, at least in terms of volume, again, highlighting the volume and the volatility piece, we should see more volume as a result on a lot of names because people are buying and selling more aggressively, theoretically. Damn it, I said theoretically. I said I wasn't going to say it. Also, in theory, there could be greater systemic risk. So undercapitalized individuals could force liquidations, and that could cascade across assets. So that could cause a multiple chain reaction over and over and over on the market as a whole. Less of a concern. I feel like that's like a doomsday scenario, or when we have a really red day or a really green day, there could be a bigger cascading effect, kind of like I alluded to before. But that is going to be yet to be seen. This all stems around volume, essentially. I think the last thing that we would see is actually less overnight risk and more intraday flow. So I actually think what we would see, and we know that the market actually makes, in general, the market or individual stocks make a large chunk of their gains in the overnight session or the pre-market session, right? They make the biggest moves there. There's lower liquidity. I actually think that might switch, and we actually see more liquidity, since more volume, more liquidity is coming into the market intraday, and a lot of people are day trading or day trading more aggressively, theoretically, that we could see bigger moves intraday. So in a nutshell, the effect on retail traders as a whole, I think, is a net positive. I think if people are going to make dumb decisions, then they're already going to make dumb decisions. But outside of the group of people that are going to make dumb decisions, as a whole, this is going to be a net positive for retail traders. That offers a hell of a lot more flexibility, gives them the ability to structure trades and different strategies and try new things, which I love. And as the effect on the market, I think what you could take away from everything I said, higher volume, higher liquidity, which in my opinion are both great things, especially as a technical trader. I want to see as much volume as possible and I want to see as much liquidity as possible, and higher volatility as a possibility, especially on outsized moves. Big moves down, big moves up. Short squeezes could be more aggressive. Bear moves, more fear, more FOMO could come in. I think that is what you're going to see with this change when it gets implemented in the near future. What do you guys think? Hatchet said, just got $10 out of the 667 calls. Let's go. Eddie, we have always had sound effects, my friend. What do you want to hear? Let's do, there's your oof. I just don't use them too frequently. I know sometimes it can be kind of like ear cancer. Hatchet says, SPY volume in the first hour was very strong. Dip getting bought. Combination of two things. One, the dip could be getting bought. Also, some level of a potential stop loss raid, right? You could have people who set their stops up. People who saw the overnight session and not even necessarily buying the dip, but they saw the pre-market session, and they went, I'm getting the hell out of the way. They sold, and they could have got back in, right? Volume is actually holding up pretty good. As we're in, basically like 10:30, we're still hitting 1 million on 5 minutes. That's pretty solid. So volume today is very apparent. If there was a reversal on the market, especially as we get over this, if we get over the 659 level, it's going to happen today. And as I said before, especially if you get over 663, you're going to see a massive gain on the market today. We will hit 666, the devil's number. I can almost promise you if we break 663, we're going to hit 666. And I'm not saying that makes me a bull necessarily. It doesn't. Because until we break 659.11, which you could see a clear rejection here on the 5 minute, we'll go back on the 1 minute if you want to see it a little clearer. I was off by 4 cents. I do a pretty good job at this. Until we get above that level, we're actually bearish. But I would say, at least at this point in time, the risk reward does favor the bulls, as long as all three indexes continue to move in the same pattern, which they are. They're all moving relatively the same way. And as long as the VIX continues to move down or decay. Your ultimate trigger point, breaking under yesterday's lows would be big. But 1637, you get under that level, you get under yesterday's lows, that probably is going to cook you up to like 661, 662. And then it's free falling. Yeah, the VIX is going to fall out if that happens. If that happens, because I'm free. Let's see. You would 15? VIX 15. 1550. Calling it. All of these things have to all line up though, right? It is not this is going to definitely happen. It's a series of if this, then this. For those of you that are programmers, you know you can program the if this, then this, like essentially like if this, then do this, then do this. That's essentially what we're seeing on the market. If this breaks, and if VIX is under this, which it is, and if VIX breaks lower, and if UVXY is under 11, which it is, if all of these things happen, and eventually if SPY gets over 663, then SPY will go to 666, the number of the beast. I'm very confident. You can use 6603 as a trigger. And that would be a huge move today. And that would be a crazy... You'd engulf yesterday's price action on a big freaking candle, because the low of the day right now is 655. So you'd be up $11 in one day on one candle. And also, the only way that happens is when there is some level of a catalyst out there. Typically, we had and still have multiple catalyses for the rest of the day. So the storm is brewing. The opportunities there. Again, I have not made a single trade, right? I'm not taking a trade yet. I may not trade at all today. And that's okay. I'm not going to miss out. If I miss out on the gain, I miss out on the gain. It's okay. I'm just more concerned about being right in terms of the direction of the market. Tom says, loving the new PDT rule. Yeah, I think it's a net positive for the entire market. For most importantly, retail investors. I really think it's a net positive. Oh, I want to talk about Target. Target. All right, guys. So this is target. Let me gather my thoughts here. Okay. All right, guys, this is target. Currently, we're consolidating around this 87.35. And full transparency, I recently opened a long on target, and this is kind of a knife-catching opportunity, but it may be one that you may want to consider. Now, we are near this localized 52-week low, and I'll tell you guys right now, I got in right around this like 87-ish area, and I have my stop just under this area. So, knowing that, for our second price target here, that offers me a can you see that on my screen? You can. A 3.5 to 1 risk to reward setup, where I'm risking about a 2% downside for an 8% upside on equity. What else I like about this trade is, yes, you are catching a falling knife here to some degree, but again, it's on managed risk of you're running the risk of the 52-week low. On top of that, your MACD is starting to curl up, and you're getting a volume reaction here. If you look at the last 4 days here, around my LOI here, so a key technical level of 87.35. Looking at on the weekly, this is so bad. It looks awful, and this is when I like to buy names that have brand recognition, right? People know Target, and it can get worse. Don't get me wrong. It was bad here from the start of 2025. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks, red weeks in a row. Gnarly. Now we're at 7 weeks in a row. 1, 2, 3, 4, 5, 6, 7, including this week, red weeks in a row. Typically, getting so many consecutive red weeks in a row, eventually there has to be some level of a mean reversion. And that's what I'm playing here, at least for the start of this position, as a mean reversion, risking the 52-week lows and getting back at least to 94.02. Again, offering me a 3.5 to 1 risk to reward setup. And again, from a technical basis on the weekly, this does not look great. It is pushing hard to the downside, but you have your first inkling of hope here on this current weekly candle that's forming, leaving a wick behind, almost double bottoming those 52-week lows and trying to push above my key LOI there at 87.35. Looking out on the month as well, I put my stop below those 52 weeks, and I actually anticipate to go long again if we tap the 200 MA with a stop just beneath it. So there's two scenarios here where I want to be long target stock. If my stop gets taken out, which will be about $2 lower than we currently are, I'm going to look to long again around this 81.54 area, which is where the 200 MA is currently, this dark blue line on my chart, which in general, for a lot of stocks, serves as a very key support. The last time this was tested and broke to the upside, which is right here, was back in 2012. Now, from then, Target has over doubled in value when it broke its 200 MA. At that time, it was around 34 bucks. And, you know, crazy rally since then. It went even higher, went all the way to 200 something. But even at current evaluation, it's still over double what it was almost when, whatever that is, 6x. So it had a crazy move from then, which you could be cooking up here once again. So I love Target here for a good risk to reward opportunity. Technically looking, yes, it does suck. It's not great, but the opportunity here from a risk standpoint is fantastic in my opinion, and that's why I think you may want to consider Target at its current evaluation. Again, managing a stop just under this 85.44 area. You get a little cushion there. I think what's my stop here? 84.95 is what I have risked for this risk reward scenario. 84.95, right around there. So I gave a few pennies there, gave that whole dollar amount, because sometimes you sweep down to like 84.99, right? So I don't want to get stopped out there, but not leaving too much room there. And if that stop does get taken out, my next area to watch is going to be that 200 MA at 81.55. Again, giving a little breathing room there once I get the long. And if that fails, then I'm out of the way, right? But where it is right now could offer a great long-term opportunity here on Target if you're patient with long equity. What do you guys think about Target? Eddie says, is the new PDT rule in effect now? No. It was approved by FINRA, and now it's got to go to the SEC. So it theoretically will go in effect, but the SEC has to approve it. I believe it'll probably be in effect by the end of the year. No one really knows. Here, you want me to ask? Let's ask AI real quick. When will the PDT rule go into effect in theory? Because I know there's no set date, but we'll see right now because I don't know the answer to that question. When I don't know the answer, I find the answer. So while Chat GPT is figuring that out for me, there is no fixed go live date yet. The change is still in the proposal stage, but here's what we know in my best estimate. Blah, 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 blah. Mid to late 2026. Well, it says some analysts expect the change could take effect, assuming a smooth regulatory process. So we don't know. Once it's filed with the SEC, we'll have a better idea. I don't know. I'd have to check this. You can fact check me on this. It's not something I'm privy to. I don't know if they actually have to have like a hearing on it, because sometimes with some of the new things that pass through the SEC, they actually have like a hearing on it, so people can say why they're opposed or why they're for something. So I don't know about that, but I know a lot of the big brokerages. I know Robinhood, Fidelity, I think even Charles Schwab, all have spoken on the matter and say they're of course they are. They approve the PDT. They like support it because they'll make more money. Hey, if more people can day trade, that means more commissions. Yes, please. Who wouldn't want that as a broker? All right, we're consolidating in this range here on SPY. You guys basically know what to look for. I don't really have much else to say, really. Unless you guys have any more questions, I'm probably going to wrap up around the time where we shut things down anyway. Watch VVIX under 100 as well if you want more confluence. Oh, okay. NVIDIA went off my screen here. Ooh, NVIDIA's over 177.50. That's big. That's very, 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 very big. That's big on the day. That's very big. Let me check something real quick. That's big if it sustains over this, because that was a key level yesterday. That is so important. If the bulls have any legs today, that is ultra important. That's big. On the 1 minute here, MACD flipping as well. Momentum solid. That's big. I'm going to say it again. That's a big move. That could be big. Don't sleep on NVIDIA today. I am very underwater on an options trade right now, so maybe we'll mitigate some losses today. That'd be cool. I'll hang around for another minute or two because we're about to break the red star on the 1 minute here on SPY. MACD flipping over, good momentum. NVIDIA's pushing, and we're testing my 659.11 area. So if the market's to break, it's now. You've got the support of NVIDIA. I think you got Microsoft going. Microsoft's going too. If we're to break it, now would be a really, really solid time to break and push. Again, it's muddy through here. Next $3 or $4, it's muddy. It won't be easy. It'll continue to be very volatile. But again, this is your key level, your golden level to watch today. If we get over 663.5, and I don't really need to give you the parameters on volatility, because logically volatility would either continue down or stay flat, which is basically, I need it at least roundabout where it is right now. We will mark up another $3, believe it or not. What's my target on target based? So my short-term target's right here. 94.02. First price target is 90.97. Second price target is 94.02. And again, here, I'll pull up the risk reward thingy. If you entered long roughly around here, around my LOI, it gives you 3-to-1 setup. You're risking 2% or 2.31% downside if you have an 84.95 stop. And you're risking about 8% gains to 94.02. Now, again, that's conservative, right? We could stretch this to all my other LOIs, which you can see right here on the chart. And obviously those gains change, and this, as a result, this risk to reward changes drastically. For example, if you want to go to this high of 107.73, oh, I gotta unlock it. 107.73. All right, it's right around there. 107.76. Now you're 10-to-1. So these are the kind of risk to reward trades I look for. I look for there to be, well, specifically with Target, like it's a name people know. It's a strong brand. Yes, the market's kind of finicky or whatever, but it's probably not going anywhere. And those are the times I want to buy those kinds of companies when they're getting kicked around in the dirt, especially after we hit a low, we had a push up, now we're hitting that low again, making some level of a double bottom, right? That's where I like to take those stabs, because now if it does get all the way up here, I can just move stops as we go up, and maybe I own Target now for the next 3 years. You know, maybe I maybe I just have shares until it goes to 800, right? So maybe it just works out fantastic for me. Oh man, my KC is going good. If you like KC, or if you charted this one over 16.99, this has legs for what it's worth. My shares are already underwater, so looking at call debit spread. Okay. Or you could sell puts if you want to accumulate more shares. You could sell puts 80. I mean, probably not going to be cheap, right? Well, not bad. It makes a little money on the puts. You want to sell some puts down here. You obviously need the collateral, but it's not a bad idea either. All right, didn't look like SPY broke. We actually wicked it. Look at that. We didn't wick it. We left a bar there. What was the open or the high? 605. We were 2 pennies shy on that high, and the candle before was 1 penny shy. So, again, if I give you guys these levels, you see these levels on my chart, put them on your chart because they're probably going to work. This is a very, very key level. It's a start. If you are a bull and you want to see a bull reversal in the market today, this is your start of that. Yeah, EB, that's actually what I noticed. And you know what else I noticed? EB says IV on target elevating. Look at this. I'll show you something. If I remember correctly. I could have mixed this up with another name, so forgive me, but I'm pretty sure. All right. Now keep in mind, these are the 1DTs. I'm going to show you the next 4 chains. Anytime you're looking at like a risk to reversal play, here's a quick lesson, right? Anytime you're looking at I call them bottom feeder plays when they're like in the dirt, they're kind of like near 52-week low, whatever. Look at the options chain and look at the next few weeks. Look at the OI on your calls for tomorrow versus your OI on the calls for the puts. Understand where there could be weakness. So under 87, you're going to start delta hedging negatively, right? Because you have fewer calls over here and far more puts. And conversely, over 88, you're going to start delta hedging to the upside, where there's also fewer puts and more calls. So there's more of an aggressive move potential here on target if it gets above 88, very short term. That's for tomorrow. Now, looking out for a few weeks, you see more or less the same thing. Basically, right here between the 87, 88 area, as you move up, you have higher OI on the calls and lower OI on the puts, which obviously makes sense. People buy out the money typically more than in the money. Same thing here with the puts. Go to the following week, and it's the same story. More calls, fewer puts, more puts, specifically 85, fewer calls. And again, this all works off of the mentality, or not the mentality, but the theory of delta hedging, where market makers have to hedge for the underlying positions. They buy the shares to cover the underlying positions in the case that stocks are assigned. Here you go again. Look at 90. 90 is a big level. These are your monthly contracts. This is October monthlies. 90 right now, you're negatively hedged, right? Because the market's prepared for this $5,800 or 5,800 OI on 90. But if we break 90, then they're going to de-hedge, theoretically, right, this bear position, and then hedge a bull position on 90. So breaking 90 would be a very big bull push. So you do have some level of a gamma ramp, theoretically, between now and October's monthly exposure in these upcoming weeks. So if Target gets some bullishness out of the gate here, especially over 88, you see my alarm level here at 88.11. Getting over that theoretically pushes a stronger bull narrative between now and next month, which is what I'm trying to look for at least a short-term reversal here. If Target's new, Hatchet says, if Target's new CEO starts rejecting the woke practices they followed last year, the stock will pop. Probably. His first call since announcement will be late November. Oh, I see what you're saying. Yeah, probably. It's not going to hurt. Not at all. But those are the kind of things, like, I don't think anyone really talks about when it comes to trading. If you're looking especially for like that kind of reversal trade, something you can learn probably only on this program and nowhere else. And if you learn somewhere else, God bless. But you want to look at the options chain and see if there is that ramping opportunity, especially if you're like trading meme stocks and stuff. Sometimes there's that ramping opportunity. When you guys saw me 2 weeks ago when I traded those grab 5, I think they were 5.5 calls, there was that ramping opportunity to 6.5. And I took it. And that's why I grabbed, shot up, and those calls ended up going 400%. It's rare. It doesn't always happen. And sometimes the time frame is longer. Like on Target, the time frame is at least setting up for October. but it's leaning more bullish than bearish, especially over 88. So taking a logical stab here on equity makes a lot of sense because you're only risking a few bucks downside for a potential for much more upside. It's all about risk to reward. All right, guys. Hector says he's new and his initial statement will have more impact than normal. Yeah, obviously. Oh, I want to go eat, but now the SPY is back at my trigger level, so we'll hang around for another minute and see if there's anything to get excited over or not. NVIDIA backtesting that 7750 and so far supporting it. Microsoft as well. Watch 51080. That 51080, and then from the stream the other day, 51276. Two big levels on Microsoft. Very, very, very big on the daily. Watch those two levels. We'll look at Apple. It's kind of grinding up. Not too bad. Little baby hammer on the daily so far. Meta, not great. Making higher lows, though, so better for Meta. The daily candle is not fantastic, but you could be finding support here at the 50 MA as well as your POC. So it's looking like Meta might at least not harm the bull move today if we do see a bull reversal. In fact, could help perpetuate it if the bulls show up above the open price. Remember what I said about Google? How it's your canary in the coal mine? What a daily change. I don't know if you guys saw that in real time or not, but basically came down and wicked the SAR and came right back up. Look at this reversal on Google. Really solid. You could push all the way to like 252 again on Google, realistically. Got a nice little volume bar here, so it would make a lot of sense to get back in that range. Get above the 8 EMA. Open, still cooking up to the upside. I'm really salty I got stopped out on my shares. Well, won't talk about that. Tesla. You know, I'll say this. You guys know I'm not the biggest Tesla fan. If we get over this 0.786 retracement, this goes to 450 today. I said it. We break that 444. Damn, I just moved this line. I didn't mean to do that. Crap. Aha. Control Z, everyone. There's something you could learn from me. Control Z if you don't know it. You ever make a mistake? Always try Control Z. That's your undo shortcut. Most apps it works. That's very important. That has saved me more times than not. Amazon, you're going to want to watch 221. Whole number. Good volume here on Amazon. If it is going to get a reversal, because it is looking like poopy on a ceiling tile, it needs to get over 221. And I think that's about it. I think we covered the basis here. Go back to the market. Oh, man. All right, we're going to wait another minute. Maybe it's like a watch pot never boils kind of thing. Maybe because I'm watching it right now. So maybe after I end the stream, it will finally happen. So hopefully you guys had a great time during the stream today. Hopefully you learned something. You took something away. I know you didn't make any money today necessarily because I didn't take any trades. But hopefully your time with me this morning was time well spent. There we go. That's going to do it for the week. Next week, we'll have another 2 to 3 shows. I'll announce them over the weekend on my X and on my YouTube channel. So if you're not following me already and you enjoy the show, please drop a follow or a subscribe. That way you don't miss anything. And I'll be uploading some videos onto my YouTube channel over the weekend as well. So if you want to check those out, some segments that we talked about today, I'll probably upload the pattern day trader thing and the target thing as well. If you want to go back and look at numbers and whatnot, or just hear things again, you can. Appreciate all your support, guys. And never forget that some say you need an edge to trade. Well, I like to look at things from a different angle, and that's always what you get right here on the Atomcash angle. I hope you guys have a great rest of your day. And remember, precision beats prediction every damn time. I will see you all next week.
The time has passed, and that's a wrap. You're armed with the angle and your plan of attack. While the show is at an end, your journey